Hi, I'm Jessica Taurae from PwC's Accounting Consulting Services, and I'm going to talk to you today about the transition requirements in IFRS 16, which is the new leasing standard. This is the next video in a series of videos that we've been releasing on how to implement the new standard. So IFRS 16 has an effective date from the 1st of January 2019. Entities could choose to early adopt it, but if they did that, they would need to also adopt IFRS 15, which is the new revenue recognition standard. IFRS 16 allows some practical expedients in terms of transitioning to make it easier for preparers to do so. The first one is in regards to grandfathering what is or isn't considered a lease. So for example, entities do not need to reassess if they determined that something was a service, for example, under IAS 17 and IFRS 4 in the past, that can remain a service when they move to IFRS 16. Should they do this, they need to do that for all contracts. They're not able to pick and choose which contracts they reassess in terms of meeting the definition of a lease. The standard has two ways of transitioning to IFRS 16. The first one is fully retrospective. That method requires an entity to go back to the inception of its leases to apply the standard as if it had been applying it all along. So it would need to have all the data in order to do that. It would need to restate the opening balance sheet presented and all the comparative periods that are provided. That may seem quite complex, so the standard also allows a more simplified method to be applied. That method would allow an entity to essentially present a cumulative effect of adopting it at 1 January 19, assuming that's the date of initial application, without having to restate the prior periods. In order to do this, a lessee would have to, at least for what was previously an operating lease, would have to determine the present value of the remaining lease payments under the contract. Those lease payments would get discounted using the lessee's incremental borrowing rate. Had they been able to do it retrospectively, they would have been able to use the rate implicit in the lease if that information was known, but doing the simplified approach, they're not allowed to do that, and hence the rates might be lower. In terms of the right of use asset that now needs to go on the balance sheet for operating leases, or previously operating leases, the lessee has two ways of doing that. The first way would be to essentially have the right of use asset just equate to the value of the liability. The other way is to determine retrospectively what that amount would be, but equally discount that at the lessee's incremental borrowing rate. For leases that were previously finance leases, lessees can just carry forward the previous carrying value of the right of use asset and the liability on transition to IFRS 16. So there's no adjustments that need to be made for that. In addition, there's simplifications with regards to leases that only have a remaining term of 12 months, or leases for assets where the underlying asset is of low value. For both of those, a lessee is not required to make any transition adjustments and can carry on just treating them as they were under IAS 17. So a lessee will have to decide which of the methods it wants to use to transition to IFRS 16, and there's advantages and disadvantages of both. If they decided to use a simplified approach, they wouldn't have to go back in history and try and recreate the data. They would only have to go forward and look at the remaining lease payments. So it makes it a lot easier and a lot operationally simplified to do that. However, there are disadvantages of doing that. That would be, there aren't comparative information there for users to look at. In addition, a lessee would have to reconcile its previous IAS 17 operating lease commitments note disclosure to the carrying value of the liabilities that it's put on its balance sheet as a result of applying IFRS 16 for the first time. The discount rate it uses would be the incremental borrowing rate, which in many cases is probably lower than the rate implicit in the lease had they been able to go back and retrospectively determine it, which might mean that the liabilities are higher at the date of initial application than they would otherwise be. And lastly, KPIs are going to be affected. So an entity really needs to think about carefully the messages it wants to give to its users of the financial statements about the impact of adopting IFRS 16. Thanks for watching.